So sorry to come in over there, but we actually have an earnings embargo. We'll come back to Supreme in just a bit in those earnings. But Mahindra and Mahindra Financial Services came out with what looked like a slightly disappointing set for the first quarter. The stock had sold off on Friday. We do have the management now joining in, Mr. Ramesh Iyer, Chairman and Managing Director at M&M Financial Services with us. Good morning, Mr. Iyer. Thank you for taking this call. I think two things were of prime concern for the market on Friday. One is this big rise in your provisions. From not even 1 crore in the fourth quarter, your provisions at the end of the first quarter are at 526 crores. So why the need to build up such a strong provision buffer? Is it an asset quality situation or have you run out of your buffer? I think that was one area of concern. And the other one was a decline in margins, which is pretty severe. I mean, especially if you look at it year on year. So if you could give us some color on both these parameters.
So as far as provision is concerned, it's a growing book. And we are under Ind AS, and therefore, when the book size grows, the stage 1, stage 2 provision has to go up. And our LGD has slightly moved up, and that's the reason. And you will see this correct. We are not really concerned about the overall provision. If you look at the stage 3, which has actually come down compared to March. Stage 3 has been 4.45 in March, and it has come down to 4.35 as of June. So therefore, if you really look at the stage 3 number, they have come down. And therefore, it's not worrying in a growing book. And when you are on the Ind AS, there will be some extra provision that will come in. So far as margin is concerned, it comes from two fronts. One is our product mix has changed. We have gone into little more of a Primex customer, and you will see a similar drop in our OPEX. So these kind of customer, while we offer them a lower rate, they also come at a lower operating cost and a lower credit cost. And therefore, at an ROA level, we don't see an impact arising out of this drop in NIMs. Also, that we've just increased our lending rate by 20 basis points based on our borrowing rate gone up, because when the past liability matures and you bring in new money, it comes in at a new price. And we have pushed up our price by 20, which will have a lag effect. And you will see that also getting corrected during the year. So on both the fronts, I think we are pretty comfortable. As you see the future quarters, you will see them stand corrected.
So, Mr. Iyer, when you say stand corrected, on the margin side, I get it that your product mix has changed. But is this something that could continue through the course of FY24 in terms of a range? Because it's been a sharp drop. You're sitting at about 6.8%. So where do you think you could end FY24 with as far as NIMs are concerned?
So we are looking at this going upward of 7%. We don't see that a problem because also the pre-owned vehicle mix is improving and that comes at a better yield. And then our own expectation is by third, fourth quarter, will the borrowing cost also start to come down? And that should give us some benefit.
Okay, Mr. Iyer, hi, good morning. Is generally, broadly speaking, are we going to see a lot more focus on growth, maybe slightly at the margin of the cost of spreads? Is that going to be a strategy going forward?
No, so we clearly put out, if you recall, in 22 March end, when our results came out, we put out a strategy for 2025. And we said that we want to double the balance sheet from that base. And we are very much on target for that as we look at it. It's not that we're giving up margin for growth. As I just explained, we have a product mix change coming in and a lot of vehicles which do get bought by the high-end customer. And that's an opportunity that we don't want to miss. While they do come in at a low margin, I explained that they also come at a low cost of operation and credit cost. So you will see us growth definitely coming back. AUM is growing at 28% and we have yet to see the best seasons of the year. Rural always the second half is the best. So growth will definitely be there, but I don't think it will be at the cost of margin. You will see our ROA retained like the previous years.
Mr. Iyer, the other thing, I think, I'm not sure how much you'd be able to or want to comment, but I have to ask you this, is this entire M&M RBL transaction. How do you look at this, I mean, broadly? You are the financial services arm in the group. And many have been saying, well, this perhaps could have been routed through M&M Finance, M&M Financial. Have there been any conversations you can tell us about? I mean, broadly, your perspective on this?
I think there was an answer in your question, right? I mean, this is an M&M purchase and I don't think I'm privy to any of the information. I'm extremely sorry. I don't think I can speak on this because I'm not aware of any details. And you've seen the stock exchange announcement has gone from M&M. So I think it's better for the parent to comment on, and I will not have any information on this.
Okay, Mr. Iyer, fair enough, and we'll wait to get a comment from the parent as well. But I just want to go back to the asset quality, answer for a bit. You said that provisions, which have been really high in the first quarter, they're also normalized. Can you expand on that? And within that, while the gross NPA percentage has actually come down, it's improved quarter on quarter. Can you give us an idea of write-offs? I mean, is it because there were some write-offs as well? Or in general, are you seeing just on its own, asset quality trend improve?
No, so, previously we used to have a write-off once in 6 months. Last year, we changed it to every quarter write-off. So it will not be very different from any previous years. So one shouldn't read the number this quarter to be higher as compared to the first quarter last year, etc., because the correction was taken only last year. So therefore, that will also normalize. I don't see that a problem.
So what's the figure, sir?
What is important?
No, I'm just trying to understand the write-off figure. Since now it's quarterly, what's the quarterly write-off you took this quarter?
So I think we took a write-off of close to about 300 odd crore, and they are all provided accounts, right? Ultimately, we have 18 plus, we are provided for more than 80%. So once they reach certain stage of maturity, we take this write-off. And we have just accelerated it to do it quarterly instead of doing it once in 6 months. And the most important thing one has to look at it is the stage 2 is still holding up at 6.4%, which means there is no forward flow happening to the account. And therefore, there will be no up of NPA in future if you look at the real numbers. And which is why it's important to look at the collection efficiency holding up in the first quarter at 94%. And for the first time ever in our history, the first quarter stage 3 numbers are lower than what we ended up in March. And the third, there's no forward flow. And that's the reason I say that the stage 3 going forward would look even better than what we are seeing as of now.
Okay, just one final question on the housing finance business, because it has been under pressure for a very long time. Losses, the gross NPAs have gone up. Is it largely because of competition? Is there something wrong internally? And what is the game plan now? I mean, do you see these losses continue?
I mean, if you look at the model that we got into, it was really an experimentation. We went deep rural, we did room expansion, room addition, and the loan size was as low as 1 lakh, 1.5 lakh kind of thing. And two incidents of disruption, mainly the COVID disruption. These customers find it very difficult to come back. Again, on a long-term basis, we won't lose this money, but it does take longer for these customers to really pay back. What we have done as a model is kind of made a change there. We have gone up a little high in the ticket size, and we have also changed the mix to 50% of the book would come from affordable housing. And therefore, the next 3 years, the book will be very, very different composition as compared to what we've seen in the past. And we are definitely going slow on the deep rural lending that we experimented. I think it was a learning. I think it's taught us certain lessons that, at that ticket size, it is going to be hard work with a lot of cost and then eventually delay in repayment. So we have therefore changed the model.
Okay, Mr. Iyer, we'll leave it there. Thank you very much for your time. Good speaking with you, sir. Thank you. Prakash is still with us. Prakash, you heard the M&M. I'll come to you on this later, but you were talking to us about Supreme. So please finish that.